So, if you've dared to look at your portfolio lately, you've probably seen a sea of red. Am I right? The market, especially for small and mid-sized companies, has taken a pretty serious dive. And hey, it's totally normal to feel that knot of panic in your stomach. But the big question is this just a reason to be scared, or is it something else? Let's break it all down.
This is the question on literally every investor's mind right now. That portfolio that was looking so good just a few months back is suddenly bleeding. So that's what we're going to dig into right now. We're going to uncover exactly what's going on, why it's happening, and, most importantly, what a smart investor does about it. All right, first up, let's put on our detective hats and figure out the root cause. What actually kicked off this whole downturn? Well, it turns out it wasn't just one single thing, but more like a perfect storm of a few different factors that all hit at the same time and really rattled the market. To really get what's happening today, we've got to rewind the clock just a few months. You see, the market actually hit its peak back in late September. Then, the trouble started brewing in October when a bunch of companies reported some pretty weak results. November's U.S. election just stirred the pot and added more uncertainty. But the final domino, the thing that really triggered the sharp fall we're seeing now, it was a cautious comment from one of the market's most respected voices.
Okay, let's break down those three triggers. First, those weak results in September. A lot of companies got hit hard by a flood of cheap goods coming in from China. It's a thing called product dumping, and it just crushed their profits. Second, the U.S. election. That just created a whole lot of what-if scenarios that made investors nervous. And third, the final push, was when a big-shot fund manager basically said out loud what everyone was thinking. Prices for a lot of these smaller companies have just gotten way too high.
You know, there's this saying that just nails the impact of that fund manager's comment. It translates to, when the grandfather speaks, the whole family is shaken. And that's exactly what it's like in the market. There are certain senior figures, these market grandfathers, who have so much influence. When one of them voices concern, it sends a shockwave through the entire system. And suddenly, everyone starts to panic about the high prices they've been paying.
And that's when you get this domino effect. See, when the overall mood or sentiment turns negative, fear pushes over that first domino. And pretty soon, it doesn't even matter how good an individual company is. Even healthy, profitable businesses, the ones that are fundamentally strong, they get knocked down too, just because they're part of that same chain reaction of panic.
And this brings us to a really crucial point. A market sell-off isn't just about spreadsheets and numbers. It's about psychology. We have to understand the human behavior and the structural pressures that can turn a little dip into a full-blown downturn.
So what's adding fuel to this fire? It's really three main things. First, people are cashing out of their mutual funds. For instance, you know those special tax-saving funds called ELSS that have a 3-year lock-in? Well, when that period ends, some folks decide to take their money and run, which forces the fund managers to sell stocks. Second, there's a strategy called tax loss harvesting. And third, you've got good old-fashioned panic selling from everyday investors trying to protect whatever profits they have left.
Now, for anyone who's not heard of this, tax loss harvesting is actually a pretty common strategy. It's where you sell an investment that's down, so at a loss, and then you use that loss to cancel out the profits you made on another investment. The goal? To lower your overall tax bill for the year. It happens a lot, especially when the market is falling.
But here's the catch with that strategy, and it's a big one. Let's say you sell a really good company just to save a little on taxes, and then you immediately buy it right back. You haven't really solved anything. Sure, you saved on taxes this year, but since you bought back in at a lower price, your potential profit is now even bigger when the stock recovers, which means you'll be facing an even larger tax bill down the road. You're just kicking the can down the road.
You know, all of this might be giving you a little déjà vu. And if this whole situation feels familiar, well, that's because it is. We've actually seen this movie before. So to get some perspective, let's take a quick look back at the small and mid-cap downturn from 2018-19.
Okay, so at first glance, today looks a lot like 2018-19, right? Both times, small and mid-cap stocks were falling because everyone was worried about high valuations. But, and this is a huge but, look closely at that last row. That's where you see the massive difference. Back then, company results across the board were genuinely bad. Today, well, for a lot of good companies, that's just not the case.
And folks, this is probably the single most important thing to understand right now. Unlike that last downturn where weak profits kind of justified the fall, today many well-run companies are actually posting solid results and growing their earnings. They've spent the last few years expanding, paying off debt, and just getting stronger. So the dip in their stock price isn't because the business is broken. It's because the market is scared.
Okay, so with all that context, what are we supposed to do about it? How should a long-term investor react? Well, this is not the time to freak out. It's the time to have a plan. So let's open up the Smart Investor's Playbook for getting through this.
Now, before we get into the nitty-gritty of the playbook, I just want you to look at this number, 26,000 crore. That's how much money flowed into systematic investment plans, or SIPs, in just one recent month. It's a massive sign that underneath all the scary headlines, there is a huge steady river of money from regular investors still flowing into the market, buying up stocks during this dip. That's a powerful force.
And this brings us right to the playbook. The rules are actually pretty simple, but they're incredibly powerful. Let's start with the do's. Do invest systematically. Do focus on simple businesses you can actually get your head around, like a bank or a company that makes a product you use. And do check their track record for the last 5 or 10 years. And the don'ts? Don't just chase whatever's hot, like government-owned companies or solar stocks, just because they're popular. Don't try to perfectly time the bottom of the market. Trust me, nobody can. And the biggest one, absolutely do not invest with borrowed money.
And really, the heart of this whole strategy is the SIP. By putting in a fixed amount of money on a regular schedule, you automatically buy more shares when prices are low and fewer when they're high. It's a simple, disciplined way to take the emotion out of investing and actually use these market dips to your advantage.
So when you step back and you put all these pieces together, the picture really starts to change. This doesn't have to be a crisis. In fact, for a disciplined investor, this is the exact moment where fear gets turned into opportunity.
And this next quote, it captures this mindset perfectly, even though it sounds totally crazy at first. A smart investor isn't on their knees praying for a quick recovery. No, they're actually hoping the market stays down for a while longer. Why on earth would they do that? Simple. Every single day the market is down is another day you get to buy great companies while they're on sale. It's a chance to load up.
So let's just hammer this point home. The real goal right now is not to hope and pray that the market bounces back tomorrow. The real opportunity is to use this period of pessimism to systematically buy up shares in strong companies that you believe in for the long haul.
At the end of the day, a market downturn like this isn't really a test of your stock-picking genius. It's a test of your patience. It's a test of your nerve. The next few months are going to separate the gamblers from the true investors. So the only real question left is, which one are you prepared to be? Thanks for tuning in.